What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be checking out McDonald's stock. And the reason I picked this one today is because the other day I found out I heard about a rule or a law where if you're a competitor that sells chicken, like Raising Cane's or Chick-fil-A, you are not allowed to open a restaurant on the same side of the street as a McDonald's location. And because we were supposed to get one by us, I don't know, earlier this year sometime, and I guess it got blocked because McDonald's said you can't be selling chicken on the same side of the street as we are. So I figured let's do some analysis on the stock. Let's see if it's at a healthy valuation and let's see if it's a good time to buy. So really, this stock has been a huge underperformer. The last 5 years, it's only up 48%. That is pretty weak. And so you got to consider that you might not get the highest return with this stock, but it pays a dividend. It's a pretty solid company that you shouldn't have much downside risk. And I mean, if you buy at the right time, you could make some more money. So we are looking at free cash flow yield of 3.1%, which is, I would say, just mediocre. I'd say it's good. I wouldn't say it's bad or outstanding, just somewhere in the middle. And we have a dividend yield of 2.3%, which is not a ton, but as interest rates are dropping, we're going to be more and more desperate to get a dividend. So 2.5 or 2.3% is not that bad. Revenue somehow peaked in 2014, and we have not gotten back to that number yet. We're doing, let's see, last 12 months, we are at almost $26 billion, right? And 10 years ago, we did $27 billion. Net income is probably net income. The chart for net income looks a little bit better. As you can see, it's a little bit more trending upwards versus the revenue from 2014 to 2020 definitely had a downward trend, but now, we're looking strong. And so net income is looking good. Dividends, I like the dividend chart because they consistently increase the dividend, which is good. The cash to debt ratio is not good, but I mean, I think for this type of business, I think it's different because of they're probably prone to more debt, more capital lease, and all that stuff. So it is what it is. Shares outstanding is good. This is a good chart. They're buying back shares. Then we have return on capital of the profit margins of 33%. And look at what I really like is look at the consistency and look at the growth here. 2007, 10.5%, and now they have more than tripled that number to 33% last year. So that's just outstanding. Return on capital employed, 23%. So that's fantastic too. And, I like most of these numbers are good. I like a lot of these numbers, but as far as the valuation goes, we can see here that right now it's pretty much right in the middle, right? It's traded up as high as 31 a couple years ago, and then that time doesn't really count, but just a couple months ago it was trading at 22 times. So I would like to pay, I would say 23 times would be good. I would say 23 times or under would be good for forward, even for forward earnings. So let's say 23 times 12.6 would be 289. And so we're really not that far. If the stock dropped, I don't know, a couple percent, I don't think it'd be a bad buy. Now let's go back to this chart. So we have 22 there right now. Now this is also trailing earnings too, so you got to consider that. But let's do 293 divided by 11.8. We're looking at about 25 times. But again, this is not one where I would expect to outperform or have, 30% gains in a year unless you buy at the right time. So I mean, look at this if you bought on July 9th at $245 and now it went all the way up to 316. So you could have made a lot of money there. Right now, I don't know if that's going to happen. I mean, the stock is almost flat. I mean, you go back, let's see, what is that? 293 now. Just, I mean, 2 or 3 years ago, the stock was at 270, 275. So it's barely moved in the last 2 years. And that's why I would really, if you want to make a decent amount of money with this, I would try to buy it when it has these dips right here. If it came back down to 250 or something, 260 even, then you might have a chance to make more money. But other than that, buying right now, I think you're just buying at a fair valuation. You get a decent dividend. The stock shouldn't fall too much, and it should continue to grow at, maybe 10% per year, something like that. And then you're getting that dividend on top of it. So that is my analysis for McDonald's. I like it. I think the numbers are good. I just wouldn't expect huge profits to be made unless you're buying on a huge dip. So That is my analysis for McDonald's, and thank you for watching. I will see you in the next video.